Welcome everyone to the latest edition of the Shaw and Partners monthly video update. Now this will be the last video update that we do in 2025, so let's kick off by quickly checking in on the returns over the month of November. At a very high level, we saw mixed outcomes. Now the Australian share market weakened off, as did the tech-heavy Nasdaq index, but the US benchmark S&P 500 eked out a small gain, as did the broader European market. The local share market fell 0.4%, and the MSCI All World Index in New Zealand dollars also had a small fall, 0.4%. But look, these figures somewhat disguise what has been quite an eventful month. I mean, for example, if we look at the Nasdaq index, it traded a range of approximately 7% over the course of the month before finishing down 1.5%. And I'll talk to some of the AI-related factors behind that volatility. And we saw a similar, slightly smaller round trip in the S&P 500 as well. But look, it wasn't only share markets bouncing around. Interest rate markets had a choppy month as well. The US 10-year rate, the 10-year bond rate, that's one of the most widely watched interest rate products in the world, also moved around a fair bit over the month as well. And at one stage, trading up towards sort of 4.15 and at other times down below 4%. Now, local interest rates were also the centre of attention following the Reserve Bank of New Zealand policy meeting, which was quite late in the month. And it's prompted a reasonably significant shift in interest rate levels, and I'll talk more about that in a minute. And let's just work through the machinations of the US market, though. We had the longest US government shutdown in history, and that was front and centre in the first half of the month. And I think it's fair to say it did impact on market sentiment. It was affecting the release of important economic data, thereby also raising questions about the ability of the Federal Reserve to monitor economic developments and make decisions on monetary policy, let alone the extent of the impact of the shutdown on broader US economic activity. Probably more relevant, though, in explaining away the volatility in the US market was the ongoing AI story. And a key event over the month was the release of quarterly results from NVIDIA, which were yet another example of the enviable position it occupies in the AI space. And actually, it was a pretty strong result. But in a general sense, it was a month in which mega cap tech stocks and AI-linked stocks like NVIDIA faced valuation scrutiny. And by the end of the month, there was quite a variation in outcomes for those types of companies, because despite the strong quarterly result, at the end of the month, the NVIDIA share price had fallen almost 13%. Microsoft was down 5%, but Google had lifted over 13%, and that was on the back of its AI offering. Gemini was gaining momentum, and also positive sentiment around its new proprietary chip. And we saw evidence of what we call defensive rotation. So sectors like healthcare, utilities, and consumer staples came into favour at the expense of the more recently favoured tech sector. Now, this focus on inflation we've seen all year certainly didn't dissipate. And again, broadly speaking, there is a disinflation impulse, or at least sentiment that inflation is contained. Now, towards the end of the month, US markets started to adopt the view that in December, the Federal Reserve will deliver another interest rate cut, and then over the next 12 months, more monetary policy easing will be in the pipeline. And this tends to reflect the stated views of Federal Reserve members. There was quite a bit of what we call Fed speak over the month, but also signals that the US labour market may be softening. But look, we need to see a little bit more data to form a strong conviction over that. What is interesting, though, is that locally, the interest rate story is unfolding in a slightly different manner. The Reserve Bank has been steadily lowering the official cash rate in response to their perception that there's plenty of spare capacity in the economy. Certainly, the very weak growth outcome for the second quarter and other recent data releases have suggested weak levels of demand in New Zealand. And the bank has formulated the view that this low level of demand and spare capacity should see inflation pressures ease through 2026. And that'll bring inflation back down from the upper boundary of their target range, that's 1 to 3%, and CPI inflation will eventually settle near the midpoint of that range in 2027. Now, at the most recent monetary policy statement and cash rate review in late November, this view was expressed. And forward guidance to us appears to be that the hurdle for further interest rate cuts is quite high. So the ICR is now at 2.25%. And they're now adopting what we would call a wait, watch and see position. The wholesale markets now are not expecting further interest rate cuts. In fact, current market pricing is suggesting a reasonable level of probability that towards the end of 2026, the official cash rate may be going up. Now, this view has caused a bit of a reset in New Zealand wholesale interest rates. And if I look at the benchmark 5-year swap rate, and back in October at one stage, that was down under 3%, 2.92 I think was the low. But as we record this, that rate has climbed back to almost 3.5%, so it's moved quite a long way. Other wholesale rates have also lifted, which suggests that we may have seen the low point in fixed rate mortgages. Now, last month, I did say that we were a little bit more constructive on the health of the local economy, and in a gentle rebuke for the overuse of the term green shoots, I adopted my preferred term, looking for flickers in the New Zealand economy, and I suggested last month that they were evident. And that observation has been bolstered over the course of November. So we had the most recently released ANZ Business Outlook. It showed not only the highest levels of business confidence in over a decade, but also that businesses' own current activity has picked up. Now, building consents, we've seen them post modest increases over the last 3 months as well, and third quarter retail sales were stronger than expected. So this is it's all painting a picture of what I would call modest improvement, and housing market activity has lifted. Unfortunately, though, yet we're not seeing any associated price rises. I think we can expect a better economic environment in 2026, but I would also suggest we keep our expectations in check. The recovery will be patchy and it's unlikely to be frothy. Now, we stand by our view that this is a very dynamic macroeconomic backdrop, and our role is to react to that from an investment perspective, and that is still very much the case. Look, we've shifted our investment view a little bit. We're less enthusiastic now about investing in local fixed interest, so we've initiated an underweight exposure there. We're still slightly favouring growth assets, and that's evidenced by still having an overweight exposure to domestic listed property and a bias to Australasian equities, and we're just getting a little bit more interested now in the New Zealand share market, and we're still highlighting global funds with diversified exposures, and we are still a little cautious in the short term around our exposure to those magnificent 7 companies. But financial markets are continuing to deliver attractive returns. And if you'd like some guidance in how to participate in financial markets, consistent, of course, with your investment objectives and your risk tolerances, why don't you get in touch with us? And we can help you navigate what are now quite challenging market and bring our decades of experience to assist you, providing for your financial future. It's that time of year, though, when family, friends and fellowship become far more important than financial matters, and we sincerely hope you can find time to share with your family and friends. We will still be here looking after your investments. So we wish you all the best for the festive season. Have a great Christmas, have a break if you can, and we look forward to seeing you invigorated and refreshed in the new year. But if you want to know a little more, you can look us up on shoreandpartners.co.nz or Facebook and LinkedIn. We are everywhere, and we'd love to hear from you.